Welcome back to another explainer. Today, we're breaking down the incredible, rapid evolution of the AI industry using some of the latest market reports. We're right in the middle of a massive, fundamental shift in the tech sector. We're officially moving away from the era of AI experimentation, and we are stepping right into the era of industrial-scale AI deployment. And honestly, it's completely rewriting the rules of cloud computing and hardware economics. Let's just dive right into this absolutely staggering number. $725 billion. That's the combined capital expenditures projected for 2026 by the major tech giants. That is a massive 77% jump from last year. Think about that for a second. We're talking about Google, Amazon, Microsoft, and Meta collectively pouring $750 billion into data centers, power infrastructure, and chips. This is not just a routine upgrade cycle, folks. It's a full-on arms race to build the underlying physical infrastructure of the new economy. So, to understand exactly where all this money is actually flowing, here's our roadmap for today's explainer. 1. The $725 billion AI bet. 2. The Q1 2026 cloud war. 3. Escaping the NVIDIA tax. 4. The custom silicone solution. And 5. Alphabet versus Microsoft investment. All right, part 1. The $725 billion AI bet. It's one thing to just say companies are investing heavily, right? But it's another entirely to see how it's fundamentally altering their core business structures and balance sheets. This brilliantly illustrates the intense capital requirement of this era. Companies are literally restructuring just to afford the hardware. Meta, which has historically been a very capital-light money machine, actually increased its full-year projection to over $145 billion. They cited higher component pricing and intense competition for land and power. They're shifting resources from human capital to physical compute capital, just to keep up with the overwhelming demands of training and running these massive AI models. Now, despite some investor anxiety over these, frankly, capital-intensive incinerators, market analysts are firmly asserting that the revenue growth completely justifies these historic outlays. When you look at the Q1 earnings, Alphabet posted an 81% increase in net income, and Meta's revenue grew 33%. So the demand for these services is absolutely exploding. This means that $725 billion isn't just going into a void. It's being spent to capture very real, surging customer demand that is hitting the market right now. Moving right along to part 2, the Q1 2026 cloud war. So the cloud is really where the AI rubber meets the road for enterprise customers. And notice the stark contrast we have going on here. While AWS and Microsoft are definitely boasting massive run rates, Google Cloud is experiencing a blistering 63% growth surge, totally driven by AI demand. Google Cloud actually reached an $80 billion annual run rate. And as their CEO, Sundar Pichai, noted, enterprise AI solutions have officially become their primary growth driver. Microsoft and AWS are growing at a very healthy 28%, sure, but Google's growth is just accelerating wildly right now as they bring more AI-native services online. Looking at the resulting $129 billion global market share, we can see AWS is still maintaining the lead, but wow, this three-horse race is tighter and way more lucrative than ever before. AWS holds 28%, Microsoft is right behind them at 21%, and Google sits at 14%. This entire global cloud infrastructure services market increased by over $35 billion year over year in just the first quarter. But, beneath these massive revenue numbers, there's actually a hidden cost crisis brewing, and it's forcing these hyperscalers to completely rethink their entire hardware strategy. Which brings us to part 3, escaping the NVIDIA tax. So why are these cloud titans so incredibly desperate to change the underlying economics of their data centers? Well, with NVIDIA controlling roughly 86% of the AI GPU supply, hyperscalers are facing a fundamental bottleneck that is just chewing straight through their profitability. Right now, to build these massive cloud data centers, AWS, Microsoft, and Google have all had to buy hundreds of thousands of general-purpose GPUs. But here's the thing. When one single supplier completely dominates the market like that, it creates an extreme imbalance in who actually captures the profit. The absolutely crucial point to understand here is that every dollar paid to NVIDIA for capacity is the dollar surrendered right to their profit margins. That creates a desperate need for a structural escape hatch. Think about it. If Microsoft or Meta pays top dollar for an NVIDIA GPU, NVIDIA walks away with an incredible 73% margin. That is a massive premium. It's exactly what the industry is calling the NVIDIA tax. The hyperscalers have realized they simply cannot build a sustainable, highly profitable cloud business long-term if they're basically giving away 3/4 of their hardware spend as pure profit, straight to their supplier. And that brings us to the great hardware pivot, the massive shift away from flexible, power-hungry GPUs and toward purpose-built application-specific integrated circuits, or ASICs. Now, don't get me wrong, GPUs are fantastic. They're highly flexible, they're the absolute standard for researching and training new models, but they consume a massive amount of power. We're talking up to 700 watts for a single H100. ASICs, on the other hand, are highly specialized. They just do one thing, but they do it incredibly well. They consume 60 to 65% less power, and they can actually be up to 67% cheaper to run when we're looking at the specific task of AI inference. And this is where it gets really interesting. By 2030, inference, which is the act of running those already trained AI models, is projected to consume 75% of all AI compute. That represents a $255 billion market where ASIC economics just absolutely shine. See, training a model is a one-time, massive computational event. But inference, generating an image, summarizing a document, answering a chatbot query, that happens billions of times a day. If you can cut the cost of that daily inference by 50 or 60% using an ASIC, the savings at a hyperscale level are literally astronomical.
Let's head into part 4, the custom silicon solution.
And they aren't just talking about this in boardrooms anymore. They are deploying these custom chips into their data centers right now. Nearly every hyperscaler is currently designing chips alongside partners like Broadcom and Marvell to finally break that supply chain dependence. Google actually has a massive 7th-generation head start here with its Tensor Processing Units, or TPUs. AWS is running a dual-chip strategy with Trainium for training and Inferentia for inference. Meanwhile, Microsoft is aggressively trying to catch up with its Maya chips to support its massive OpenAI workloads. And Meta, they're utilizing their MTIA chips internally for things like ad and feed ranking.
This right here is a massive validation point. One of the world's top AI labs concluded that Google's TPUs simply offer superior economics for their future. Anthropic, the makers of the Claude AI, they aren't just dabbling, they are committing to gigawatt-scale capacity. Google Cloud's CEO explicitly cited price performance as the driving motivation here. Look, when a leading AI lab chooses ASICs over GPUs at this staggering volume, it definitively proves that the custom silicon strategy is fully viable at the very highest levels of the industry.
And the real-world savings are just undeniable. A 65% cost reduction from Midjourney shows exactly why the silicon shift is accelerating so fast. They went from spending over $2 million a month to under $700,000 just by porting their inference workloads from traditional GPU clusters over to Google's TPU v6e. I mean, that is over $16 million in annualized savings. This is the exact math that makes custom ASICs the clear path forward for production AI.
Finally, let's wrap up with part 5, Alphabet versus Microsoft investment.
When we look at these businesses as a whole, assessing their competitive advantages in this AI era is absolutely critical. Looking at Q1 2026 operating income in billions, AWS posted $14.2 billion, and Microsoft's Intelligent Cloud segment posted $13.7 billion. So they are generating massive current profits. Then, shifting over to Google Cloud, sure, they are smaller at $6.6 billion, but get this, that is up from just $2.2 billion a year earlier. That's an astonishing 203% growth. They're scaling their profitability rapidly, and that's thanks in large part to the vertical integration of their TPU hardware, software, and cloud stack, which is really expanding their margins. Financial analysts are noting that while Alphabet clearly boasts the growth and silicon advantage, Microsoft offers really robust stability and a currently cheaper entry point based on operating cash flow. If you look at this structurally, Alphabet has this incredible advantage in custom silicon with their TPUs. But Microsoft has a deeply entrenched business software footprint that is highly resistant to economic downturns. And right now, metrics indicate Microsoft is trading at a much cheaper price relative to its operating earnings, whereas Alphabet's recent stock rallies have kind of pushed it toward decade-high valuation levels. Now, we aren't here to pick a winner for your portfolio, but rather to show you that both of these titans are fundamentally reshaping the entire global tech economy. Microsoft is brilliantly leveraging its vast enterprise reach and that massive OpenAI partnership. Meanwhile, Alphabet is capitalizing on its years of custom hardware research to offer aggressively priced, highly efficient AI compute. They're both navigating this $725 billion AI build-out, but they're doing it using entirely different historical strengths. So I'll leave you to ponder this final thought. As AI inference inevitably consumes 75% of compute by 2030, which giant silicon strategy is really going to win the decade? Thank you so much for joining this explainer, and definitely keep your eyes on the data center space, because the hardware choices these companies are making today, they are completely going to dictate the economics of the technology we'll all be using tomorrow. See you next time.